Today the topic is on MFRS. One more thing. I've noticed many names there that seem to be occurring since I was doing this many years ago, all right? And I've seen most of you, so welcome back. And some names I'm not familiar. Maybe I'm not familiar because I don't really know the name or I can't place a face to it. I could not see the 150 faces on the screen just now because there's only a limitation on the projection on the screen. Anyway, welcome. And today's topic is on MFRS 116, which is actually internationally known as IAS 16. So it's about property, plant, and equipment. Relatively, to me, it is a simpler standard as compared to many other standards like the MFRS 9 and a whole suite of standards that relate to financial instruments and a few other groups of standards that are quite complicating. But I think in terms of PPE, the standard per se is not very difficult, but the application of the standard, a lot of people don't actually apply it correctly in practice. In practice, a lot of people do not actually understand the standard or just overlook it or just gloss over it without actually bothering about the requirements of the standard when they are acting as an accountant or financial preparers, etc., etc. So what I think is a lot of people coming out are very theoretical in their approach. Of course, as you know, this program is designed to bridge that gap between the theory and the real life practice. So I will share on the real life practice since I've been in practice for 50 years now. So I will share all those things that relate to this sort and peripheral standards that may be also affected by this, right? So there is also an update. I haven't started to move the slide because sometimes people put a note there and say the slide is not moving. I haven't started. I'll let you know when I move the slide. All right. The other thing is they have incorporated an update, a very recent update. The update was issued in 2020, but it is to be effective from 1st January 2022. And this is about proceeds before the intended use of that plant and machinery and how is it to be dealt with. I was told that there were some problems in interpreting this. So when we go through it, we will look at the standard, what actually has changed. Fundamentally, only two major paragraphs have changed. The rest are all just supporting. All right, so it's not a very difficult situation. And I think in one of the questions that I did give yesterday or the other day, which MIA may have already sent to you, included this particular standard, right? As if it is already in force. So what would you do? And what would you do if it's not in force, all right? It's coming to force 1st January 2022 with early adoption being allowed. So 2022 is, well, shall we say, not very far from the corner. So then it'll be adopted in full. But remember, you can still go backwards because early adoption is permitted. All right, I'll move the slide now. And if you have any problem or it's not moving in your screen, just let MIA know or ACCA know you will be attended to and they'll inform me accordingly, all right? Okay, overview of this whole thing. Now, what is it? What does this standard relate to? It must relate to something, right? PPE is one big thing. So the key focus areas that we are looking at is what is the scope of the standard? What does it cover? What exactly are PPE? All right, people say PPE, property, plant, and equipment. So is it only property, plant, equipment? What sort of equipment? What is in, what is not in? All right, so we'll examine what's not in because that's most important. Due to new standards being issued, sometimes the newer standards tend to take over certain functions of the principal standard. So you may also have to refer to two standards, you know. All right. So the next thing is, how do you recognize? This is most important. The recognition of PPE, initial and subsequent, because this standard has got a lot of issues about what exactly are initial costs and what exactly are subsequent costs. Some things that look like costs are not actually costs that is supposed to be capitalized. They should, in fact, be expensed into the profit or loss, but they get capitalized. A lot of this also depends on people, especially the older generation of businessmen out there and company directors. They tend to look at the olden way of looking at capitalization. If they don't want to charge off certain expenses into the P&L account, which would actually reduce the profit or the distributable earnings, they charge it to the PPE because they say this relates to the PPE. So why do you want to expense it? So capitalize it. So they keep capitalizing a number of things that should not be there. And of course, as you know, in order to recognize something as an asset on the balance sheet, it must qualify as an asset based on the framework, right? The conceptual framework, of course, that was revised about 2, 3 years ago. That conceptual framework is the basis on which most of the standards are based on. All right, while it is a conceptual framework and it is already revised now, they call it the concept because that is the concept on which the standards are based. We must know what is an asset. So I'll go through a couple of slides on that afterwards on determining what is an asset and why an asset on the balance sheet must be able to generate economic benefits and how they do so. As when they are not able to generate economic benefits to the company, what do we do with them? There is that wonderful word called impairment. So we'll also examine that, something that has to be used quite often, especially in the last 2 years. Right? A lot of assets have deteriorated, a lot of things. I'll talk about that when I go through the program. And then, of course, the next thing we have is once you've identified how do we measure the elements of cost. Sorry, the spelling there is cost. Should be what are the elements of the cost. So this is when you recognize something. The standard is framed like this. When you recognize what are the costs that you take up. Sometimes an asset, after you have recognized it, you still incur certain costs. And how do you deal with those costs? And how do you do with measurement after you have recognized? What do you recognize initially? Do you take the cost or do you take a revalued amount? Right? Now, what is the cost and what is revalued amount? When you acquire a property, there is no difference between a cost and a revalued in most cases. I wouldn't say in all cases, in most cases. Because in the normal arm's length transaction, the seller who is selling you the item, the property, plant, and machinery, is going to sell you at a price that is the market price. All right? Unless he give you a very special discount, but still he is able to make a profit. It's a market price. So a market price could have a range, but you are the buyer. To you is the cost. So the selling price, which is the exit price or fair value under MFRS 13, right, or IFRS 13 if you're using IFRS, the exit price is the selling price to the seller. To the buying person, it is the cost price, which is actually the fair value. So that's the initial measurement of cost. Subsequently, you might add on things or whatever, the cost may increase, and that is measurement after recognition. You may revalue the asset. You will have to depreciate the asset in most cases. What sort of depreciation needs to be used? Don't use standard rates. In the olden days, people say, oh, this one, a plant and machinery, this one about 10 years. So 10 years, we put 10% per annum. It's an arbitrary flat rate. That was good in the olden days I would say that in the 60s, 70s, 80s, 90s, when accountancy was not as sharply focused as it is today. As time goes on, the demands of accountancy are very different because investors are getting very, very smart. They want information and they want it accurate and fast. So, and the information must be something they can rely on, not something that they can, just look at the number in the figure and invest. And I'm talking about serious investors. I'm not talking about those investors who listen to other people and say, hey, that one can buy, that share can buy. Okay, la, buy. La. I'm not talking about those. We are talking about serious investors, right, who are looking at numbers in the figure, numbers in the accounts to see whether that money that they invest, is it worth it? So if you have an asset that is over bloated, which in real life cannot generate economic benefits, cannot generate money to the company, but it is still there on the asset on the balance sheet looks good only. But if you were to do an impairment, there'll be a big chunk of it going to P&L account, in which case the earnings don't look good, right, in terms of the assets, because the assets would have gone down in value. So we'll discuss that when we're talking about measurement after recognition, revaluation, and depreciation. And then, of course, impairment of an asset. Impairment could be many things. Assets grow old, assets get damaged, assets maybe are destroyed by fire, something like that. So, how do we deal with such impairment? And then, what happens if we get a compensation, an insurance compensation for this impairment? How do we deal with that insurance money, the amount that we get? Do we knock it off against the asset, or do we charge it into the profit or loss? So there are specific provisions in MFRS 116, and you'd have to actually charge it to profit or loss. Whatever impairment of the asset, or if the asset is totally destroyed and it's written off, you got to write it off to the profit or loss. And the income goes to profit and loss. There's no question of on the balance sheet set off and whatever remains there, no. All right? Decommissioning, removal, and restoration, called by many names. This is another important area, especially in large companies which have big assets that are required to be installed in the factory or in a location or in a piece of land. And you need to do a lot of work on that land and maybe foundations for that machinery, the plant or whatever. And when you leave that place, you need to put everything back into its original condition. So this is called the decommissioning of the plant, the removal and the restoration of the place back to its original status. Because when you lease a piece of land or a factory or any premises, you are doing it on the basis of taking it as it is, and the lease agreements will always say that you must put it back in condition that you saw it. So maybe your factory needs a lot of renovation, a lot of reinforcement of the foundations, whatnots, all those stuff. You need to do a lot of structural work. They're going to cost a lot of money. So the issue here is for that decommissioning, you cannot wait until the end of the period. Let's say that your lease is for 10 years. So you have done all your work, bought the machinery, put and spent a lot of money in the installation of the machinery. Then you say, all right, 10 years, we need to pull it out. That's a long time. We'll talk about it in 10 years. Maybe you even have a 20-year lease. They say, oh, that's too long. Why don't we wait until 20 years? Why are we talking about it today? Anyway, who would know what the cost will be in 20 years? But unfortunately, no. The provisions in MFRS 116 clearly tell you from day one, you got to determine what is the provision at the end of the period that you expect to leave the premises that you have leased. and then find out the estimated cost. Of course, if you ask the contractor today, he will tell you, wow, you want 20 years time? Well, this one has gone up, the price of that gone up. I also don't know. I can give you an aga estimate. That's what the contractor will tell you. You ask him 2 years down the line, say, yeah, subject to price. You ask him 10 years or 20 years, what kind of reply in practice would you expect? Of course, the theory is in the books. It tells you, oh, you estimate. But you try doing it in real life. But when you press them and you tell them, so you will get an estimate. So the only way in practice it is done is to ask 2 or 3 different contractors to give an estimate of the figure. And then you start to look at the average of that amount because nobody will know what will happen, all right, in 20 years' time. So having said that, and you got a figure for the purpose of the demolition costs, decommissioning costs, you need to get that figure and discount it, getting the present value of that amount. If it's 20 years, then you got to make sure that you discount it for 20 years. And what discount rate do you use? The rate that is prescribed in the standards in most of the places, which is your weighted average cost of borrowing. I did also give a question yesterday, which is in your question, the quiz there. How do you determine the weighted average cost? I think it's very easy, right? It's one of the easiest things, but it looks a very complicated word. In practice, it's pretty easy, right? And I will talk to you about it when I come to that particular topic. So you discount this amount that the contractor has given you for the 20 years down to the present amount. Now, that amount that you get discounted, you need to add that to the cost of the initial cost of the property, plant, and equipment. So you see, the cost of the property, plant, and equipment is not only the purchase cost plus all the attendant costs to bring it to its location and condition. It is also cost of future dismantling that goes into it right from day one. And in practice, this is something many companies had a problem trying to understand because many directors always query on this. Why on earth are you talking about a 20-year thing now? What are you accountants trying to do? All right, so simply you increase the fixed deposit for what? The fixed assets for what purpose, right? You see, it took a while to get them to understand this. So this is an area that is something that when you're an accountant working for big multinational companies, even big Sendirian Berhad, they have a lot of big projects. They will have this and they will find it difficult to really understand. I'll go on more on this when I talk about it, all right? So the next one, of course, will be we are looking at the main, the screen is slow, so I'll just think. How do we dispose of the fixed asset? So when we dispose of the fixed asset, we can actually sell it as scrap, or we can sell it as a working machine, or we can decide what is the price that you want to sell. When you want to dispose of any plant, machinery, or any fixed asset, or PPE for that matter, especially the bigger ones, you will have to determine, right, whether or not the selling price is worth taking. That means the recoverable price. So let's say a machine that you have been using, let's say it's $1 million machine, and you have used it for, and let's assume that it has a 10 years lifespan. So naturally you would depreciate it over 10 years. Not just depreciate it, you need to look at it every year, but we'll talk about that later. Let's assume you depreciate over 10 years. So at the end of 5 years, you think that newer machines have come on the market, more efficient, and more production units can be made from them, less consumption of electricity and power and things like that, and therefore it becomes more cost efficient. So you may want to invest in a new machine. all right, and you want to get rid of this old machine. You got about 5 machines, let's say, 5 of these big ones. So you want to get rid of one of them or two of them. And the book value would have been depreciated by half over 5 years. So it's about 500,000 in the books, 1 million, right? So if you put it up for sale, when a buyer comes and looks at the machine and he says, how much you want to sell? 500,000. Yours is older machine, 5 years already. Now there's new technology on the market. I don't think I'm willing to pay 500,000. I can give you 200,000 if you want. So you say, wow, my books is 500,000. If you pay 400, 200,000, I'm going to make a loss in my books of 300,000. Is that worth it? Is it worth it? So you begin to think, is there any other way? And that's when the accountant is going to tell you, right? Look, there is. Why don't we put it to use? And then the director will tell you, what? We already want the more efficient one. Why you want to put the old one back again for what? You see, now this is the issue. There is something called value in use, VIU. It simply means what happens if you continue to use the machine for another 5 years, all right, based on the existing output. You calculate the projected cash flows. Of course, do the assumptions right. Anybody can do a projected cash flow. I can do for you. Just tell me what number you want at the end. I can do a beautiful one for you. But it is not worth the paper it is printed on, because the numbers in that, all the assumption must be realistic, right? So if it's realistic and you come up with something about what will be the profits and you discount the profits, right, or the cash inflow, you discount the flow up to the present 5 years, 5 years from up to the end, you discount it. What value will you get? If you get a value of, say, 450,000, all right, that means if you continue to use it, you will actually earn 450 at the discounted value, right? Not at the full value, at the discounted value, which means that it is a very good price as compared to what people want to buy at 200,000. So you'll be testing the realizable value against the value in use, right? And then I'll talk about later. This is the type of things that you need to look at when you're disposing of. And then if you sell off, how do you deal with the gain and losses? Do you put the profit on disposal into the profit and loss account for a PPE item, or certain types of PPE item like landed properties or machinery or something else? Would you put all of it into the profit or loss, or some of it don't go to the profit or loss? They go to other comprehensive income, or OCI as we call it in short, OCI, other comprehensive income, all right, which is actually below the profit and loss account, and which will not impact all the calculation of the ratios from the profit. The profit is above all this OCI. So OCI is like an escape thing, but you simply cannot put things in OCI lah. So what are the criteria for items to go into OCI insofar as PPE is concerned? All right, why do they go there? Why do they go the other side? We'll talk about that when we come to it. And of course, the final one is for preparers of accounts. You need to do a lot of disclosure in the financial statement, because whatever is in the standard, right, whatever you do in the accounts is absolutely useless if it is not disclosed, because the reader or the user of the financial statement is actually looking at the accounts. So you can say, oh, I did this, no, I did that, no, I made provision, I did an impairment, and I tested the value in use, but there's nothing in the account, nothing in the notes. So this last thing about the disclosure is a pretty important thing in terms of actual presenting the accounts to the investing public. That's what they want to read. All right. And that's why today, the financial statements, as you see, is no longer the financial statement that you would have seen way back in the 70s, right? It's a far cry from that because that time there were no standards. Right now the standards have become so many standards, and they are always developing and upgrading. It gives you a lot more information. Of course, people do say, lah, there's so much information, I don't know what to read, so I don't bother to read. Lah. Why don't you give me something brief? Well, in some countries that's been done, some kind of a bridge note, but that is not international, lah, all right? It is selectively done in certain countries. So when you follow the standard, a lot of disclosures come in, and that is where it is very important. The weakness I noticed in Malaysia, especially in the smaller groups of companies, the larger ones, because there's a whole bank of accounting team there, so they can debate easily. But the smaller ones tend to miss out. What they tend to do is they look at some other accounts and say, oh, you did like that, I copy and paste. All right, they try to do this sort of thing. So it's important to impress upon the students of accountancy that the final product that you produce as an accountant or as a financial controller or as a finance manager, whatever you're called, right, is what people are going to read. And there are prescriptions on what you need to do. So you need to interpret that. All right, so this is the big picture of the whole program that we are doing. And we will just look at what it is. Now, before I go into it, it's always important to understand the conceptual framework. I'm not going through the conceptual framework. Every time we do the TDT, we have the conceptual framework. This time I'm going to touch it only very little, but the pertinent points, all right? I'm not going to go in all the details of it, but the points that are relevant for us to understand today's topic. All right, now this is the revised framework that was actually already implemented on 1st January 2020. Actually, it was already, you could implement it much earlier, all right, but the official date was that. So the purpose, of course, is, as you know, as I mentioned to you, the problem with the accounting profession out there in the commercial field is that everyone is sort of does his own thing, right? And so you may not have a congruence when it comes to actually looking at the financial statements. The only thing that happens to make it okay is when the auditors start reviewing it. And if you're talking about listed entities, it's usually the big four auditors or the medium big ones that are there, who are actually under the supervision of the Audit Oversight Board. And I'm sure you know the Audit Oversight Board is extremely strict and suspend many of the auditors if you do not actually get your review done. All right, you can see that those are publicly done. And of course, now MIA is also doing the same thing to all other auditors who are not under the Audit Oversight Board, that is non-public listed auditors. Those who do all the audits, everything, are also under the regulator of MIA, which is very strict now. And if you get a type 1, type 2, type 3, type 4. So the moral of the story is that there are regulators now who are actually putting things right by catching the auditors. But the auditors is one. By right, it's the finance people who prepare are the ones who are supposed to do. So now the auditors are going to push the people who are doing finance. And so the finance people suddenly wake up and say, wow, every time I never do this, now you ask me to do this. Now that's because they never actually understood the real focus of what it is like to be an accountant, right? Getting a degree or getting a qualification is only one step. The application of that knowledge in practice is very, very essential if you want to get your career going. And so you want to get the company to respect you as an accountant, that you know what you're doing and that your accounts have a certain standard and not some bookkeeping standard stuff. So this is a framework to assist on policies. Accounting policies are the basis on which the financial statements are drawn up. What are the policies? How you recognize an item, how you measure it, how you present it, and how you disclose it. The four main elements. So these are the things that are policies that are the framework. And also, sometimes in the very rare instance, where you get a situation where there's no accounting policy, and you may need to develop an accounting policy, the framework will give you a guidance. But in practice, this one is very rare because the standards have become so versatile and applicable everywhere that only in very, very rare instances of certain types of exploration where there's no standard, because it's so rare, then you may need to develop a policy, but that policy must fall back on the conceptual framework. All right. Now, when the standard allows a policy to be selected, would you like this policy or that policy? Then you can follow. You cannot follow if the policy doesn't. For instance, if you say the policy of inventory, inventory is stated at the lower of cost and net realizable value, which means that if your selling price is above the cost, you cannot say, hey, I want to take the selling price. Why should I take the cost? That is ridiculous, right? You cannot do that. So you have to take the cost. If your selling price is lower, then you must provide for impairment. So it doesn't allow you anything other than lower of cost and net realizable value for inventory. But wait, the same kind of classification of inventory for another industry is different. For agriculture, when you have, let's say, you have a durian plantation, right? And the durians fall to the ground or you pluck them. Gone are the days when you wait for the durian to fall, all right? You will never be able to make money. So they have people harvesting durians, huge amounts of durians. So when you have a balance sheet date or a year end or a period end, and you want to determine what is the value of the durians on the ground that you have accumulated for the purpose of selling it to the wholesaler, you cannot say low of cost and net realizable value. Net realizable value you can get. But what is the cost? Can you tell me what is the cost of one durian that falls from the tree? There is no cost, right? Or rather, it's a humongous task and next to impossible task to calculate the cost of one durian on the tree. And even if you do calculate, it'll be a nonsense figure. So the only way is to use another policy. Selling price less cost to sell. So if you're going to take the durians and send it to a wholesaler, that wholesaler is you have to hire a lorry, and then you have to get all those people who were workers who are cutting down the durian fruits for you. All of that cost set off against the selling price of the durian. So if you sell to a wholesaler in, let's say your farm is in Pahang jungle, and you sell it to a wholesaler in Kuala Lumpur, so your transport, your cost there, and he buys that whole lorry load, let's say for 10,000 ringgit, let's put a simple figure, and your cost of the lorry plus the workers and all is about 3,000 ringgit. So in substance, your net realizable value or the figure that you put in the account for inventory would have been 10,000 minus the 3, which is 7,000. All right, that is the figure you'll get. You won't have net worth. So this is what you say, a choice in the accounting policy. It must be relevant to what you do. So one is on selling price less cost to sell. The other one is on lower of cost and net realizable value. So you must know where to use this kind of different policy. Similarly, you can have a policy of valuing your items of assets, or you can choose at cost. But again, where the standard does not allow an accounting policy choice, you cannot simply value everything. Land and buildings, you can do valuation, and there are rules to it. Once you value, you must do continual valuing periodically, which I'll talk about it when we come to that stage, right? Can you also value inventory? Every now and then I want to increase my inventory, all right, retail items. You can't. So the policy doesn't allow you a choice there. So these are some of the things that are in the framework that if you go through it, there's quite a number of items that we need to do. And that is what the whole standard is based on. Now, there are five elements in the financial statements. One is the asset, all right, whether it's non-current or current, they're all assets. Another one is the liabilities. Again, whether non-current or current, they are all liabilities. And then you have the profit or loss. So the profit or loss has got income and it got expenditure. The net effect of the income less expenditure is a surplus. Where does it go? It belongs to the shareholders. So it goes to the equity, which is on the balance sheet. Just now we talked the balance sheet about assets. We talked about the balance sheet on liabilities. The balancing thing is the equity and the retained earnings, which is coming from the profit and loss account. So anyway, that I think everybody knows. But the principle is when you put something on the face of the balance sheet as an asset, right? That asset must actually follow this definition, which is a present economic resource controlled by the entity as a result of the past transaction. So it must be something. If you bought a plant and machinery, you bought it as a result of a past transaction and you have ownership to it. So it must be controlled. The word controlled is a very big word, not necessarily ownership. All right. For instance, like MFRS 16 tells you about leasing, right? It's a leasing. As we know that formally when we lease an asset from a leasing company, the asset doesn't belong to us. So what did we do? We used to expense out that item into the profit and loss account as lease expenses, operating lease, like rental of tractor, rental of premises. But the standards have changed and they have brought that into the balance sheet, right, as part of an asset. So, but the asset doesn't belong to you. So they give it a new name, the right of use. You have a right of use. When you have a right of use, you must control that right of use. So that's why you see in the leasing, there is so much of words you need to understand. If you don't control the right, you will not be able to take it up as an asset. And that all comes back to this word controlled in the framework. All right, you must control it. Control it does not mean you have an ownership, but you control it for that period before you put it on the balance sheet. All right, and it must have the economic resource. All right, it's a present economic resource, and that economic resource, which is that asset, is a right that has the potential to produce economic benefits. That means it must be able to earn income. If you put an asset on the balance sheet, which is the whole theme of today's talk about the asset on the balance sheet, PPE, it must be able to have the potential to produce economic benefits. In a very simple layman's term, that asset must earn income. If that asset cannot earn income, don't put it on the balance sheet, write it off. All right, it should not be there because it doesn't follow the framework definition of an asset. So that's why it is very important. So let's look at the various definitions here. The right to potential income. The right means you have a right to receive cash, you have a right to receive goods, you have a right to exchange that asset for something else on favorable terms. Like for instance, we are only not talking about the right on just PPE. You may invest in a bond, you may invest in shares, you may invest in many other type of things. You have a right to receive the cash if you are really going to be able to sell it. So you have that right, right? And potential to produce economic benefits. So it must produce a benefit, mean inventory, investment. It must actually give you dividend income, able to sell and earn the income like inventory. If you cannot sell the inventory because you got a lot of old stock, impaired stock, but it is still sitting in your inventory and makes the inventory look good, but cannot sell. So will there be economic benefits? No. So that's why to bring that down, you need to put the other standard, the impairment standard, to bring it down. And then the balance sheet gets cleaned up. Okay. And of course, control. As I mentioned to you, the word control, all right, is an economic resource. You must be able to control the ability to use that asset to earn your income, in simple language. All right. So these are the basic things that the conceptual framework talks about. Now, I'm not going to go to all. I'll look at the liability a little bit and then we will move on. All right. So a liability is also important because whenever you buy an asset, there will be a corresponding liability. So a liability is a present obligation. It's not a past obligation. All right. It's not a future obligation. So if any future obligation, then it becomes contingent. That's why a contingent liability does not come in until the liability crystallizes, then becomes a present obligation. We need to be careful to understand what is a present obligation that could be payable even in 10 years' time. All right. So it's a present obligation, but payable in 10 years' time. So you may have a term loan from the bank. And let's say they give you a term loan now, 1 million, payable in 5 years' time in one lump sum. So would you say that, oh, it's not present obligation? I'm not obliged to pay now. No, it is an obligation that you need, is a liability. Because anytime they can call back the loan if you default, right? Or anything, or any of the, what should I say, the ratios that they kept for you, the covenants, the bank covenants. If you breach the covenants, they can recall the facilities they want. So it's always a present liability, present obligation, not a liability. But this liability is payable in 5 years' time. So that's why in the financial statements, we would state the terms of repayment so that people can understand. Otherwise, people look, oh, must pay now. This company got money or not? So you see, this is how the financial statements are designed to be looked at. Now, the liability has got a present obligation to transfer an economic resource as a result of past event. Transfer economic resource is a big word. You ask the layman and say, must pay money. Yeah. You want to, you take these goods, you must pay money. I give you 3 years to pay. So there's a present obligation as a result of past transaction. I bought the goods and I need to pay money in 3 years' time because he gave me 3 years credit. Okay, simple as that. So there must be an obligation for a liability. There must be an obligation. There must be transfer of economic resources. Can there be a liability which says you no need to pay, but just put the liability in your books, but no need to pay? You don't transfer an economic resource, there is no liability. All right? And the liability must be present obligation that exists because of something. It couldn't come out of the blue. So if it comes out of the blue, there could be fraud. Right? It must be something that exists as a result of a past event. You bought goods, therefore you owe money. You took a loan, you owe money. You issued a bond to the public, you owe money. Or you issued a private bond, you owe money. All of these are liabilities, right? Now, I won't go through income and expenditure because that's not the thing of our topic today. But I think I should go on this item, expenses, because in the PPE we have impairment, we have depreciation. So it goes to the profit or loss, and this is the profit or loss. So when you talk about expenses, they are decreases in assets. So when you have a depreciation, that is an expense. When you have an impairment of an asset, that is an expense that goes into the P&L account, right? And of course, if there's an increase in liability, why is there an increase? You may have bought something, purchases of goods. The purchases goes to profit or loss. The liability goes to the balance sheet, right? So there must be something that will increase the liability, and that will be the other leg of the entry going into the profit or loss. Not everything that goes to the profit and loss will increase your liability. Some are on the balance sheet. You can buy a tractor on credit. So you debit the tractor in the PN in the balance sheet, right, which is the PPE, and you credit payables, or rather, the creditor payables. So it didn't go, but the depreciation will go in, right? So because this is a purchase of an asset, but normal expenses will be going into the profit or loss. All right. So all of these decrease in assets or increase in liability that result in decrease in equity. Naturally, when your expenses are high, right, the profit will become lower, right? So the more expenses, the final profit go lower, maybe even a loss. And where does this profit flow through? It goes to the statement of changes in equity, which is actually the shareholders' account, or rather substantially, not all, because the statement of equity got many things, but it's got to do with shareholders one way or another. So these will in undoubtedly reduce the retained earnings, and therefore they will be reducing the equity, because the retained earnings is always added to the equity. So if you got a bigger retained earnings, your equity plus retained earnings is much bigger. If it's smaller, your equity plus retained is smaller. That's why it's going to decrease it. Of course, don't count in distribution of dividends, etc. Those are all non-trading items. Okay. All right. So with that, this is the residual interest of equity. So I will leave that out as well, because we are not doing this. So now we will come on to the actual PPE. Now, as what you have been told earlier, if you have any questions, please put it in the question box. I'll address them, all right, as we go along, or at the end of the day, or whenever it's suitable, because sometimes if there's a lot of questions, I'll handle it earlier. All right, now, what is a PPE? What the student of accountancy should know is the principle of what a PPE is. We need to get that message across. Reading the words in the standard here, and I'll just read it to you. You see whether an ordinary person of accountancy will get the full picture. It says that they are tangible items. Well, what sort of tangible items? That are held for use in the production or supply of goods and services. Yeah, fair enough. All right. Or for rental to others. Now, I highlighted that for a particular reason. Or for administrative purposes. That means your own office. And it's expected to be used for more than one period, of course. All right. Otherwise, it'll be a current item, not a fixed, or rather a item of fixed asset, so to speak. All right. Now, look at the first word, held for use in the production and supply of goods. So all your assets are in one way or another going to generate income, right? Is held for the purpose of generation of income. Assets like machinery, tractors, what should I say, factory, all those equipment inside there, they're all used for the purpose of the factory manufacturing operations, which actually comes out with a product or a few products which you're going to sell. All right. Now, without that plant and machinery, you could not have earned that income. So it is used for that purpose. For rental to others. Now, if you have a PPE item, you have a tractor, all right, or a group of tractors, and you rent it out to people and earn rental income. Now, that is also okay, because it's used to earn income. So now, what about a situation if you own a 10-story building? All right, you own a 10-story building. It's shown as PPE in your books. And you are going to now look at the 10-story building and say, I think we got too much capacity. We are only going to take 3 floors for our office, which is administrative purpose. And the 7th floors, we will rent it out to the public so we can earn income. Because at the moment, our office is small. So we will leave it there like that. Now, How do you classify this 10-story building? Because 3 is a PPE, and that is for administrative purposes. The 7 floors are actually earning rental income. Now, if you had looked at the other standard on investment property, right, the standard on investment property clearly says property for the purpose of earning rental income or capital appreciation or both. So if you're earning rental income, it is called investment property. And if you're earning, keeping it for capital appreciation, just buy a piece of land and keep it, is also investment property. Or both. You could be actually buying it and eventually selling it for capital gain. So they are termed very specifically as investment property. So what do we do with this whole building here? Do we separate out the 7 floors, right, as investment property and the 3 floors as PPE? Right? And is it possible? The answer is simple. Yes, it is possible. But it's going to take up a lot of resources, a lot of money to get a valuer to value it in two parts. All right. Obviously, the whole building has only one value. To split the two, and then you put one part as investment property and one part as your office, which is PPE. Now, the next question to ask is, if there is investment property, what are the valuation that you need, methods that you use on investment property? Now, the standard clearly says investment properties can be shown at cost, but you need to do valuation and show it in the notes to the account. It is mandatory to do valuation only on investment property. So if you're going to do that, that means say that 7 floors must be valued on a regular basis. And in practice, regular basis means the valuer must look at it every 3 years. But not that in the intervening 2 years, nothing to do, no. You still need to get a valuer certificate that there is no appreciable change since the last valuation. So in practice, what is done is companies negotiate with valuers. Now I'm going to give you a long-term valuation, but you have to make sure you give me a equitable pricing. So on the first year, you value, you charge whatever price you need to charge me based on your valuer's schedule. In the next 2 years, you must give me a letter. If you feel there's no appreciable change in the valuation, give me a letter to say that there's no appreciable, and don't charge me like that. But it's been done anyway, they don't charge much. So 2 years, you get that letter. The third year, value again. So now, this is what we are talking about. Is it undue cost or effort in getting the valuer to value something? All right, now we will talk about that a little later, but let's look at this. In this building, the 10-story building, if we segregate like that, then the PPE, what are the rules on PPE? The rules on PPEs is shown at cost. You can opt to do valuation, but once you do valuation, you got to do regular valuation. Now, of course, since you're doing the whole building, so might as well do the building, all right? What if you say, I don't want to do a valuation? And what if the company says, we are only renting this temporarily? This building, because it's new, we have moved in just, we only have 3 floors. We are not going to keep this empty until we fill it up, isn't it? It makes no commercial sense. So they rent out. But what is the intention? When the tenancy expires, maybe after 3 years or 6 years, we will take on another floor as we expand. So as we expand, we'll be taking up the floors one by one. We don't know how long it's going to take, but the intention is this whole building is going to be used for our offices. So if that is the intention, then you are going to treat the whole building as PPE. So that's why you see, if you treat the whole building as PPE, it is for the production and supply of goods. But just observe this orange color writing, for rental to others. So therefore, a building that is owned by you, intended to be used by you, if you rent it out temporarily, you can still show it as a PPE. You don't have to classify as investment property. That's why you have these wonderful words put in there. All right. So, and is expected to be used more than one period. All right. Now, moving on. What goes into the cost? All right. The cost of an item shall be recognized as an asset if, of course, future economic benefits can flow to the entity and the cost can be measured reliably. So, when you put partitions in a building, all right, this is your building, you put partition. Would it would it be good for the partition, or is the partition going to give you economic benefits? Now, of course, if you have offices, you can't be leaving everything open like that, confidentiality, noise, whatnot. So you may need to partition maybe different departments, maybe different type of work that they are doing. So you need to partition is part of the work. So it's going to produce economic benefits. What happens if you say, oh, the aircon pipe is leaking. We need to change that pipe. Is it going to give you economic benefit? The original aircon is already giving you economic benefit with the pipe. The changing is not going to be capitalized. The changing is going to be expense to the P&L account. All right? Now, what happens in another case? You have a big machine in the factory, a plant, let's say plant and machinery, a big plant. And this plant has got motor in it, an electric motor that is driving the whole machine, all right, major component. And there is another heating section of the machine, and there's another part of the machine that does something else. So three major components. So the whole machine has got a lifespan of 10 years. Let's say manufacturer's recommended lifespan. But he tells you this motor you must replace every 5 years. If you don't, when the motor burns out and it stops halfway while running, it's going to damage the other parts of the components like the heating and the extrusion or whatever it is. So the question is that motor a PPE? Obviously it is. All right. And it is necessary for that item to be put into the machine in order to be able to generate income. Now, what happens if the life of the machine is only 5 years, but the life of the whole plant is 10 years? So we call this component depreciation when we come to it afterwards. You depreciate the motor over 5 years, but you depreciate the remaining parts of the component over 10 years. So when this motor has come to the end of its useful life in 5 years' time, what did we used to do previously? Previously, in practice, what they do is take that motor out, throw it away, or rather sell it as scrap or sell it as second-hand, whatever. All right, that goes to the P&L account. And buy a new motor and fit it in. So when you put the new motor, what do we used to do previously? We charge it off as repairs and maintenance. Why? Because old thinking was that the entire machine is 10 years lifespan. So we also depreciate the motor also by 10 years lifespan. Regardless of 5 years is spoiled, we throw it away, put it as repairs. Now that is the wrong way of doing it. So now what happens is that economic benefit of the motor can only last for 5 years. So because it can last for 5 years, you depreciate the motor over 5 years. And then take it out of PPE. All right, take it out of PPE at the end of 5 years. Put in a new machine, a new motor. If the new motor has gone up in price, put the new price in and continue now to start the depreciation of the new motor for the next 5 years. So future economic benefits will flow to the entity and the cost can be measured reliably. So these are major components, and that is component depreciation, which is on another part, but we must understand the definition first before we move on to that. There are also special items, and these are things like what I did partly mention, but I haven't gone through it now. Spare parts. Now I'm talking about big spare parts. I'm not talking about small spare parts. All right, when you're talking about big spare parts like things like a spare motor, like our plant and machinery just now, let's say the whole machine is 1 million ringgit. The motor itself is 400,000 ringgit. The electric motor, all right, 400,000 ringgit is significant. It has a lifespan of 5 years, let's say. So you don't want to be in a situation where suddenly the motor burns out or has a problem. It comes to a grinding halt, and then you got to go and get a new motor, and there is downtime in the factory. Now, when you're running a plant, a factory, every minute that the machine is running, every minute that the factory is running means you are generating income. You are covering your costs. The minute you stop something, it means your cost is going up and your revenue is not going to go up. So it is very important to make sure things don't stop. So you will have a spare motor sitting down, a 400,000 ringgit spare motor sitting down in your factory. In case that one burns, take this and put it and then send that for servicing and repair, whatever. So the downtime is very low. The question, what do you do with this big motor of 400,000? Is it a PPE or is it inventory? Is it inventory of motor? All right, stock of motor. You're keeping a spare stock. So obviously, the purpose of this motor is to generate income, all right? Not directly by selling it, but by using it. That means you're going to put it into the PPE and keep running the machine, and then you're going to generate the income. So you wouldn't call this inventory. You will call this PPE. So spare parts like this, all big one, aircraft, when MAS or AirAsia or whatever airline when they buy planes, they have spare engines coming along with it, because in the event there is a problem with one of the engines, one of those jet engines, you cannot say, "Hey, hang on, people, this thing must take a few weeks to repair, so I can't fly you." You can't do that in an airline. All right. So the minute something goes wrong, all right, they will take it out of service, just change the machine, take out the old one, put a new one, and then work on the old, on the spoiled machine. So they must have this on standby. All these are actually part of PPE because they are going to generate income when used. Only they are not used now, right? They're not used now. And you cannot exclude them from the balance sheet. So they are part of PPE. Standby equipment. Now, what is standby equipment? So again, very similar to the motor, you can have a lot of equipment that you need to stand by in case you need to do something. So this is also part of PPE. So many kind of standby equipment, even firefighting is a standby equipment. So when you have firefighting equipment in a factory, would you call that, oh, no, it doesn't generate any income. How can I show it as an asset? Now, firefighting equipment is not going to generate income, but it's going to prevent any income from being stopped being generated. So firefighting equipment will be capitalized and put in the factory. So these are all special items which don't directly earn income, but preserve the factory's ability to earn income. Servicing equipment. You may have a lot of machinery or whatever things that you have that requires to be regularly serviced in-house. All right, you need to. So all this equipment that you have for servicing, again, is it sort of capital item or is it inventory? Here it is very dicey. It could be either one. Certain types of servicing thing could be in the form of inventory. Certain type of equipment could be in the form of assets. So you have grease injectors that you need to inject grease into the machines. These are all equipment. But the grease itself that has to be coming on with it will be part of inventory. So you need to know, you need to understand the business. You need to be actually hands-on to be able to understand. So this is something that students must be taught. Like, when they go out to become an accountant, don't just sit in the office and say, I am an accountant, or I have a degree, so I know everything. You know the theory, you don't know the practice. The only way to know the practice is to always tell them, and this is what I tell my staff always, ever since day one they joined the firm, I always say that you must get your hands dirty, your legs dirty, even your face dirty, and be in the situation of that business. And then only you'll understand exactly as an accountant what actually goes on there. If you want everything clean, prim, and proper and just look like this, all right, you are not going to be learning very much. You'll forever be a theoretical person. Because to understand, we must talk to the machine operator. For instance, like if you're looking at a PPE and you're given the fact that the PPE, actually I should talk to you later, but I'll talk to you straight away now so that it is all flows through. When you look at the machine, we all look as an accountant at the machine and say, oh, what is this machine? What's the useful life? Oh, 5 years. Okay, 5 years, depreciate 5 years. 10 years. Okay, depreciate 10 years. So what do? We start taking the calculator. All right, what's the cost of the machine? Add whatever cost it, come out, oh, divide by what? Oh, this is the depreciation. You got a good number. But did you see the machine on the factory floor? All right, and this is exactly my experience. When one public company came up to me at the time when I was doing the audit, and they told me, oh, yeah, we have been looking at our machines. The machine is being depreciated for 15 years. Of course, those are big, big machines, a few $1 million of machines. And they come and tell me after the 11th year, 10th or 11th year, the directors have decided to extend the life of the machine and reduce the depreciation because the machine life is actually about 30 years. And they bring out accounts from other similar companies, all right, publish accounts to show me, look, this is a similar business. They're using similar equipment and machine. They are depreciating 30 years. We want to depreciate 30 years. Now, if I was to sit down and say, oh, yes, they also 30, yeah, your machine look the same. So I say, okay, 30 years. You know what I'm doing? I'm actually extending the life of the machine, which means depreciation is going to go down, which means the profit is going to go up. This is straight away a red flag in my mind. Why are you pushing the profit up? Because I noticed your profit is going down over the last few years. This is due to knowledge of your company. The company has got a life cycle for its product. You see, a life cycle. So when the life cycle has reached its peak and you don't have new products to put in on the market in order to make sure that you keep up your sales or move it up, their competitors or their new products, your sales will slowly begin to come down, right? So the only way to do, a shortcut way, is to put a booster. Reduce the depreciation, push up the profit. Oh, very good. So when they asked me to do this, I said, I need to go and check your machines. So I went. There are 3 locations where the machines were. One was somewhere in Ipoh. I can't remember the name now. All right. Another one was in somewhere in Batu Arang side. Another one was in Seremban, in the industrial area there. So when I saw the machine on the first one, it is a very big machine, and I spoke to the machine operator. Hey, your machine like going to collapse or going to what, the burst or what, making so much noise. He said, yes lah, the boss, I tell him so many times, change the machine. He don't want to change the machine. He said, the motor, how many times table pakai already? Every time something go wrong, they got to take it out, send to the shop. Sometimes 2-3 weeks cannot this thing. I said, good lah, you go goyang kaki only lah. He said, yeah, what to do? Machine don't run. What can I do? You see, now you get the picture on the ground means that that machine is not going to even last another couple of years. And yet the directors are telling, can we increase by another 15 years? You see, that's what happens. And the other 2 machines were no different. So at the end of the day, I didn't allow. As an auditor, I said, no. You look at the machine yourself, you tell me whether can. I spoke to your machine operator. You see, if you didn't speak to them, you wouldn't know. That's why I say, as an accountant, we must teach these people. One thing is, of course, to pass the exam. The other thing is to be very streetwise and be on the job when they start working. All right? Because actually, the fun is when you speak to all these people, you learn about your own industry that you're in, is when your breadth and the depth of knowledge increases very wide. All right? Theoretical knowledge is good, but you must put into practice. So this is one of them. So all of this will be recognized in accordance with MFRS 11, sorry, it's 116, not 112, when they meet the definition of property, plant, equipment. I'm sorry, this is the wrong thing. It's not 112, it's 116. Huh? When they meet the definition of PPE. So if any of this meet the definition of PPE, like a spare motor is going to generate income, it meets the definition. Grease doesn't meet the definition. It is a consumer item, so it'll be inventory. So it depends on which it goes in. All right. Otherwise, they are classified as inventory. So here is where you need to understand the definitions, and of course, recognition rules. An item of property, plant, and equipment is recognized only if it's probable that you are going to earn money from it, as what you saw in the framework. Now you see the framework flowing into the standards. So economic benefits must flow to the entity. Money must come in. I mean, I'm talking as layman's language. There could be other economic benefits, of course, besides just money. But generally, at the end of the day, it's going to increase the ability of the company to earn money, right? And the cost can be measured reliably. So it's very important to put a figure that can be measured reliably. If you got no figure to it, then you cannot put in a number on the balance sheet and just put an aga figure. Then this whole thing is about an aga set of accounts. Let's do another slide before we will break for tea at 10:45. So a recognition rule, I put some asterisks here because they come up in the subsequent slide. So between the initial recognition and subsequent recognition, what's the difference? So it says that initial recognition is always at cost. And I did explain just about earlier that the selling price is a fair value. The acquisition price is the cost. The olden day definition of fair value was arm's length transaction between a willing buyer and a willing seller, both of whom have knowledge of the market. That's the old definition. That's been changed by IFRS 13 or MFRS 13, fair value, to be the exit price. So exit price is selling price. Obviously, a person selling is selling at the best price that he thinks he can get, all right, or whatever is suitable for him. So that selling price is fair value. For you, you're buying it at the same fair value because you're a willing buyer. But to you, it becomes the cost, right? So that's the relationship between cost and fair value on acquisition. Selling price is fair value, acquisition is cost. Now, the cost elements comprise all directly attributable costs. Here again, there is a lot of mistakes in real life. Sometimes not even directly or remotely attributable also goes in. Because as I mentioned earlier, people don't want to put in the profit and loss account, charge it in there, in bringing the asset to the location for normal use. All right, and they comprise all this attributable, could be initial cost, subsequently you need to improve the machine, subsequent cost, subsequent recognition, after the first recognition, maybe the second year, third year, fourth year. You can do either cost or revaluation, provided the standard allows you to revalue, right? Need to apply the same model consistently for each class. So if you have land and buildings, and you want to do revaluation of land and building, you do a revaluation of all land and buildings. But if you got two classifications in the account, one is just land. You got plenty of land, no buildings. So you you put that in your financial statement in the notes as land, and another one land and building. Then the question is, do you revalue land together with land and buildings, or do you have only one? Now, if you look at the standard, it tells you the suggested classes. And once you put a class, those classes are individual. So you can actually choose to revalue land, but not land and building, unless you group your land inside land and building. If you separate it based on the standard, then you don't have to, all right? And the valuation differences will go into OCI. I'm going to talk about this in a short while. So give me a bit of time when I come to the expected slide. I'll explain in detail on this part. Depreciation, systematic basis, yes. And you must make sure you check it annually. I'll come to that also. Disposal, the difference between the carrying amount goes to profit or loss on disposal. That is recognized in the profit or loss. Now, here again, any profit on the disposal of PPE will go to P&L account. Any profit goes to P&L account. So what goes to OCI, right? What goes to OCI? So OCI is only those long-term PPE generally. So if you're having a long-term PPE, all right, obviously this is to generate income. Any revaluation that you do, the surplus will go into other comprehensive income. So you have a surplus in the other comprehensive income, which doesn't go to retained earning. So it goes to the statement of changes in equity and sits there as a separate column in the statement of changes in equity revaluation surplus. Now, what happens if you sell the property, all right, and you realize that revaluation surplus? That revaluation surplus you can directly transfer to the retained earnings by a journal in the statement of changes in equity. You can see that in the standard. Of course, they don't say journal. It can be a direct transfer in the statement of equity from revaluation reserve to retained earnings. Right? So you can direct, or you can bring it into the P&L account and do. Now that's where they have this distinction in the P&L account, or rather the OCI. Items that will be recycled to the P&L and items that will not be recycled to the P&L. So if you have put in under the items that will not be recycled to the P&L, so all the profits that you make on the surplus will be directly transferred to retained earnings within the statement of changes in equity. If you put it as OCI that is going to be transferred to the P&L account, then you will once you have already sold and made a profit, you will transfer it to the P&L account and then go into retained earnings, which is another route to retained earnings. At the end, both end up in the retained earnings. One goes through P&L, one does not go through P&L. Okay, clear? All right. Okay, I'll look at the next question in a short while. Let me finish this up. So depreciation and disposal, the difference between goes to the P&L account. All right, so it depends on how you put it in the OCI. Now, impairment assets must be reviewed on a regular basis to ensure that the carrying amount is not in excess of the realizable value, or, as I mentioned this morning, the VIU, or value in use. Impairment provisions required to be made if the carrying amount is in excess, of course. So here you must review on a regular basis. This is where you break that disconnect between the finance function and the actual asset. There must be a connect there. Now, can an item of PPE be expensed to profit and loss? All right, any item. So this is the recognition rules on materiality here. So always when you have an asset, why would you expense it to the P&L account? Because the definition is an asset is for you to earn income. Can you say, okay, I want to charge off this in the P&L account now? All right, I don't want to show on the balance sheet. Now, some companies do have a policy, right, on assets below a certain amount are expensed to the P&L account. Quite normal. Many companies have, especially big companies, and they don't want to capitalize it because they say all these are small amounts. Our PPE is all big amount. What are these small amounts coming in? So they can have a policy of assets that are 20,000 ringgit and below will be expensed to the P&L account. Hey, they are assets, PPE, In a small company, this is a big PPE. But in a big company, this is expense to P&L account. So how is it possible? Here you use the concept of materiality. Now, when I'm talking about materiality, it's the financial reporting concept of materiality. And there was an amendment to the word materiality in the financial reporting. Don't confuse this with what the auditors use. Auditors' materiality is governed by another standard, which is the auditing standards. All right? We use that for auditing. But for financial reporting, we use the financial reporting materiality, which has got a revised definition. So assets below a threshold, all right, remember like 20,000 or 15,000, some smaller ones put 5,000. It's common for companies to specify amount below which capital expenditure will be expended, regardless of whether it's capital or not. If a company specifies that 20,000 and above for capitalization, that means anything 20 and above we capitalize, below that expend. Then a relatively small value, materiality, relatively small value, small in relation to what? Right? Materiality like laptops, maybe desktop, and other low value items that may cost 20,000 or less will be charged off into the P&L account as an expense. So not all PPE will end up on the balance sheet, but materiality is one of the things now. I'm going to come to the materiality update, and that's what you see on this next slide. So this is the revised determination of materiality. Now, originally, the International Accounting Standards Board stated materiality was an important concept to determine what information on an item transaction should be provided in the account. But putting like this is like saying something without actually telling you something, right? They tell you, yeah, you decide, you decide. So maybe my company is all hundreds of millions of assets. So can I say this asset costs only about $900,000? I think it's not material because for me, I'm talking about a huge amount. 900,000 is not material. I don't write it. I write it off. Can we say there's no yardstick, right? So that's why many companies had difficulties of this material. It was a standard with no meaning. So they came up with a revised definition. Of course, remember, a standard setter setting a standard has to make sure that he covers as much as possible. If you narrow it down, then big companies will say something. If you make it too big, then small companies will say something, right? So you can set a sort of principle. So this is the revised definition of materiality in MFRS 101. You see, all this is linked to the standard. You have to have some idea. So this is what they come up with. Information is considered material if omitting it or misstating it or obscuring it could reasonably expect to influence decision of the primary user of this financial statement made based on those financial statements, which provide financial information about specific reporting entry. In a nutshell, it's talking about the investor, the primary user, most likely the investor or the banker or whoever it is. If you had actually put that figure in the asset or in the P&L, would it have made a difference to an investor? Would he have calculated different ratios? Return on assets employed. You have expensed out the asset. You have reduced asset on the balance sheet. Will that be a significant factor? All right, because if it is going to be significantly different return on assets employed, all right, there will be a difference. That means to say that is material. Okay, so it's a judgmental thing, and judgmental things are always something you must err on the side of caution. So this is what material is. If it can influence the decision of the user, the primary user of the general purpose financial statement, then it is considered material. Okay, all right. Now, the important information should not be obscured by including information that's immaterial or improperly aggregated. So sometimes people have a very large amount due to a director, an amount due from another director. So they are all classified in the profit and loss account as amount due to directors or due from directors. All right. Now, some companies say due from, due to is all directors, so I knock off the figure one against the other. Now, the substance is wrong. They are different directors. You cannot knock off different directors. Even if same directors, unless they agree to do so, which invariably, most likely they will, as I say, but different you can't. So this is what they call inappropriately aggregated. Now, increase the threshold to determine whether the information is material from could influence to the words could reasonably be expected to influence. Okay, so if that threshold of materiality changes, will it influence the decision of the person reading it? Or it can be reasonably expected to influence. It can reasonably be expected. To influence it, to say could influence mean you are definitely saying it will. So people will say, I won't be influenced. But could it reasonably be expected to influence is a wider range, right? So if it can, then you must make sure that that is an item of materiality and you must do it according to the standard. So don't capitalize something that's material. That's what it means, you see? I mean, don't expense, sorry. Don't expense something that is material, right? You must capitalize it because by norm, you should be capitalizing PPE. But here you are not capitalizing, you're expensing it by your own rules. So will it be reasonably expected to influence the primary user? Of course, the question is, who are the primary users? So the MFRS 101 amendment clarifies who are they. Existing investors, the existing shareholders, and potential investors. So existing could be bondholders, private bondholders, public bondholders, all right, or private shareholders, private preference shareholders, redeemable preference shareholders, all that whole, rigmarole of equity stuff there. So all of this, they could be influenced. Lenders and other creditors. A lender is also somebody who will be a primary user. Obviously, he's looking at your account before he's going to lend money to you, right? The banker. Creditor is going to at least have a cursory glance on your account. You say, oh, this company, a working capital fund don't have, man. How can I give him credit? Right? So they are going to look at all these items. Or profit and loss account is so low one, you see, and then it may influence him as well. So you must be looking at that. And the above amendment aligns the wording of material across all the MFRS standards and other International Accounting Board statements, because they also have practice statements, right? And the IASB has practice statement. So example, the MFRS practice statement number 2 issued by IASB said, making materiality judgment and the conceptual framework for financial reporting. So that definition in that practice statement is now harmonized with the financial reporting statement, which previously was a disconnect. So all these amendment has to be done prospectively, like you don't go backward. And this was already in force last year, 1st January 2020. But of course, earlier application is, as usual, always permitted. Okay, always permitted. All right. Now, oh, this slide is repeated. I see. Sorry. This is a repeated slide. Okay. This is an amendment on MFRS 116, which is actually the what should I say, the amount, the proceeds before intended use, which I believe was one of the requirements that you had requested MIA for me to explain on this. Now, if you sell an item produced while the company is preparing an asset for intended use, all right, they are telling that you transfer it to P&L account and not as adjustment of the cost of the asset. What does this mean? You see, going back to the existing standard as it were. Now, even when you commission plant and machinery, I would say normally big plant and machinery, and usually a line, a whole factory line, where the raw material can go inside one item. Let's say if you're making plastics, PVC pipes, right? PVC pipe. That whole line consists of a hopper where you put in the plastic pellets and it goes down the hopper into a heater. It's another component, all right, which melts this and grinds it up, and whatever you put color, whatever it is, it sort of blends it all up in high heat. And then from there, it goes to the next one, which is either an injection molding machine, which injects it into molds, or it could be an extrusion machine, because long pipes you don't inject, you extrude it out. All right, as it's coming out, you have a mold there, it must be it should be extruded out. And that is a very technical process. Because I do remember when I used to be going into the factories to look at all this, when they buy new machines, I always put my nose inside here, get my hands dirty and my face black as well, you know. And I learned some things like that. Every time they extruded the pipe, after a while, it came out of shape. So they couldn't explain it. Technically, there was nothing wrong with the machine. It was all engineers came from here and there, and they looked at it, nothing wrong, because the new machine that cost about a couple of $1 million from US. Then they discovered one simple problem: our weather. The machine was not made for our weather. So they had to put on the extrusion side, that early part of it, air conditioning, air blowing directly at it at the right temperature. So when it came out the perfect pipe, as simple as all that. So what we are saying is, when you are running this process for a while, because it must be perfect, they are made to certain building standards. All right, the strength, the testing, and all these things must be made to according to standard to have that standard chopped on it, right, for both local market and export market. So they have to keep this running for a while, and a lot of materials are used and pipes are coming out. They're not going to throw it away. They are good pipes. So what they do is they sell it. So what the standards say is, because the machine is not fully commissioned yet, it's running on a test run for about 1 month or 3 weeks or 1 month, like that. All right. And in that case that I was looking at, the machine was 1 month, they were testing the machine to make sure that the standard was of the right, because every time they took sample and sent for testing on the strength, on the wing, on the pressure inside, whatnots, all right. So therefore, the pipes are sold. They may not be sold as the standard pipes, as standard with a Malaysian standard or a Japanese standard or whatever it is, but it was sold because there are a lot of people buying. Now, all this income in the present standard as it is, you deduct it from the cost of the machine. All right, the machine over $2 million. So this amount of sales was deducted. So it never went into revenue, of course, because actually you're reducing the cost by selling. That's what the existing standard says. All right. Now the standard says, no, that is not correct, because you are going to breach IFRS 15 or MFRS 15. So amount received from selling these kind of items during the test, right? During the test, while it's preparing the asset, must go to P&L account. So if it is sales, it must follow MFRS 15, go to revenue, all right? And not as an adjustment to the cost of the asset. And this is from the beginning of next year, all right? It's just like that, beginning of next year. Don't deduct those costs, all right? So early applications, of course, permitted. Now, here's an explanation here in a greater detail. So this proceeds. The standard requires an item, the existing standard, requires an item to be initially measured at cost, including directly attributable costs, in bringing the asset to the location and condition. So, but before the amendments, directly attributable costs had that included cost of testing after deducting the net proceeds. So the cost will be after deducting the net proceeds from the sale of the test run, okay? From selling any items produced while bringing the asset to that location. That is the definition as it is now, right, before the amendment. So quite rightly, if you look at the standard, okay, any cost incurred, before, you must add it to the machine or deduct from the machine. Is correct. That's what it was interpreted. But the amendments now prohibit deducting the amount received from selling item produced from the cost of PPE while the asset is being prepared for its intended use. Sales proceed when you sell it, but there's also cost, isn't it? Remember, when that pipe was being extruded, where is the cost of all those pellets and all the rest of the things, the chemicals that went in to put in, all right, to come up with this? There is a cost to it also. Where do you charge that cost? So that's why I say the sales and the related costs go into the profit and loss. Obviously, don't set off the sales against the cost. Revenue is shown at gross, unless it's a discount. That is the gross after discount as well, but not after setting off the cost. So the related cost will be shown separately as either cost of sales, if you have a cost of sales, or an expense in the P&L account if you don't have a cost of sales account, which is highly unlikely. All right? So make sure that it is separate disclosure. And that is the standard. It's a very simple standard. I've put this, as I mentioned, in the question that I given to you, so you can actually see it. Now let's have a quick look on the initial cost of recognition of the PPE. All right, understand. What is the initial cost of recognition? So the standard is very simple, but the application on real life is what is more important. So I try to focus on that. But let's look at the standard. Items of property may be acquired for safety or environmental reasons. So, as I say, firefighting equipment, or you may be producing something in the factory that could be environmentally damaging, like producing pollutants that flow into the river. Now, we have heard so much of this in KL and Selangor side, where the Langad River had been frequently being polluted, even recently, all right, because of factories discharging their effluents into the river and causing a lot of problems to the raw water that is being taken up by the treatment plants. So acquisition of such PPE, although they are not increasing future economic benefits, as I mentioned, does the fire equipment increase future economic benefits? That is what PPE is supposed to be, right? No, it doesn't. Does the environmental equipment that you put there increase your future economic benefits? It doesn't, right? Factories are running without it. Putting it is only going to load the cost. It's not going to increase your economic benefit, right? Per se, it's not going to, right? So these items qualify for recognition under MFRS 116 paragraph 7 as assets because why? The reason they give is they enable the entity to derive future economic benefits not on their own, but from related assets in excess of what they could be derived had the items not been acquired. So you go and pollute the river. All right. So you already receive economic benefits from the sale of goods, right? What if the authorities fine you substantially for polluting because now the water supply was shut, whatever, lah. Or if somebody got poisoned and died or whatever happened, they are going to have you, you're going to give a heavy penalty, right? Now, therefore, that is an economic benefit that you have now avoided. I mean, that you managed to avoid the disaster, and therefore that is the economic benefit that you get. So therefore, putting something which does not directly give you economic benefit, but actually protects you from having unnecessary outflow is also an asset. And that's the example they are trying to say. So let's look at this example, anti-pollution devices and special storage facility. Now, a manufacturing company installs anti-pollution device to prevent pollutants from the factory from reaching the river, from which raw water is treated for home consumption. Now, special storage facilities are also built to comply with environmental regulation because the effluent that's coming out must be stored, all right? Comply with the environmental regulation for the production and the storage of dangerous chemicals. These plant and factory enhancements are recognized as an asset because without them, the company entity is unable to manufacture and sell chemical. So the resultant carrying amount of such asset and related will, of course, have to be tested for impairment regularly in accordance with MFRS 136, which is the impairment of asset. So remember, this is not really directly, what should I say, putting any economic benefit directly, but indirect economic benefit. Okay. All right. Subsequent costs. Now, subsequent costs, servicing costs. So how do we charge servicing costs? Is it part of the cost of the machine? Let's say you're a big plant and machinery. Do you add the servicing cost to the machine? Or do you write off the servicing cost? Or do you add the servicing cost and write off over a period of time? Okay, let's examine what the standard says. And then we look at real life. Okay, based on the recognition of a principle of paragraph 7 of 116, the company will not recognize servicing costs. Naturally, you buy a car, right? The servicing of your car is expensed off to the P&L account. You don't capitalize with the cost of the car. Every few months you send for servicing, 6 months or how many 100,000 miles, you're not going to do this thing. Similarly, a machine is carrying the same way. This thing you must charge off, right? Now, all of this will go into the P&L when they are incurred. And examples are labor cost. Obviously, labor cannot be capitalized unless you're talking about R&D, which is another topic for another day, some other time. Consumables will definitely be written off. Cost of small parts that are replaced, of course, not the major parts. All of these are charged off to the repairs and maintenance in the profit or loss. Now, what about replacement of major parts? I did explain to you just now. We go back to that example. The motor in a machine. The whole machine costs 1 million ringgit. You have a motor that's driving it, an electric motor, and it costs about 400,000 or so, right? It's a significant item. Now, what happens if you need to replace the major part? As I said, under the old standards before, not the current one that you see here, we used to take the whole machine as a depreciation of a certain period, say 10 years, and then depreciate it over 10 years. All right? And then whenever the motor burned out, we bought a new motor, put it in, and charged off the new motor as repairs and maintenance. We never touched the machine as the 1 million being depreciated over 10 years. We never touched. But all that concept was regarded as not quite correct. And so when component depreciation came up, this becomes like this. So a significant electric motor in a plant may be required to be replaced after, say, 5 years based on the manufacturer's specification. All right. Aircraft interiors like seats and galleys definitely require replacement several times during the life of the airframe. The airframe may have a 40 years or 50 years or 30 years lifespan. In fact, more than 30 years. Most of the planes are more than 30 years. So you need to change the seats because everybody come in, boom, then go out, boom, come back, boom, 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 boom. Obviously, it's going to wear out, right? So it has to be done. And also, next one is under the recognition principle of MFRS 116, the company must recognize the carrying amount of PPE, all right, is recognized to recognize in the carrying amount of PPE the cost of replacing of part of such an item when that cost incurred if the recognition criteria is met. I'll read again. So you must recognize the carrying amount of the item of PPE, the cost of replacement part of such an item when that cost is incurred if the recognition criteria is met. So if it is a motto of recognition means is generating economic benefit. Without that generation of economic benefit, all right, without the motor, that whole machine cannot generate economic benefit. So this one is going to generate. That's why remember we said when you have a spare motor, you treat it as PPE. You don't treat it as inventory. So that's why. So the spare electric motor will be capitalized. The spare seat and the galleries will also be capitalized under PPE until it is used. It's not shown as inventory. The carrying amount of those parts that are replaced, the old motor that is replaced, will be de-recognized in the balance sheet, and it will be shown according to de-recognition principle, which means that the net book value will be written off to the P&L account. All right. If you got no scrap value, if you got scrap value, you sell it for scrap minus the scrap value, whatever you cannot recover, you are going to treat it as the expense in the P&L account. All right, under the paragraph 67 to 72. Also refer to the basis of conclusion paragraph. If you got the annotated standards, you can read the basis of conclusion paragraphs, and they tell you the reason why this is done. All right, that will help a lot. So always, when you look at standard, try to get the annotated version with the BC and all explained in it. And these are from IASB, all right? If you're a member of any professional body, you should be able to access the annotated version. Normally, the free one, they won't give you the annotated version. You go to the IASB website or the IFAC website. All right, major inspections. Now, here is not service, but inspection. Service must be expensed. What about an inspection? Every time certain type of machinery or plant is very technical, you may need somebody to come and inspect it, and it's not cheap. Are you going to expense it out? It looks like it is a service. So by right, you capitalize it. And then you write it off over that period of up to the next service. Say, for instance, if it's going to be serviced it is required, let's say by the manufacturer, it must be serviced every 3 years or 4 years. Then whatever price that you paid for the service, maybe you brought in engineers from Germany, all right, to calibrate the machine, to check it, to make sure everything is running perfectly. You got to pay a lot of money. So that amount is not charged to the P&L account, but it is capitalized to the machinery. But that amount will be written off over the 3 years or the 4 years. So you write it off. Okay. Then the next service come, then you capitalize again. If it was supposed to be 4 years, and suddenly after 3 years, you say, I think we better check again. So don't wait 1 more year. And they come and check on the end of the 3rd year. You have not actually written off in full. There's another year to write off. What you do is you write off immediately that first one. And the new cost, you capitalize it for the next 3 years. All right. So it may be a condition of continuing to operate an item of high-tech plant or an aircraft that performs regular major inspection for faults regardless of whether the parts are to be replaced. You must inspect. Such major inspection may be a requirement of, say, 3 years once, maybe. All these have got specification. What are we as accountants going to do with this kind of inspection? So when each major inspection is performed, the inspection cost must be recognized in the carrying amount of PPE. That means capitalized to the carrying amount of PPE as a replacement if the recognition criteria is satisfied. All right, because it's going to last for, it's going to generate income for the next 3 years. So you capitalize it. In the event there is any remaining carried forward of the previous inspection, but not the physical parts, the inspection, they will be de-recognized. Remember I said 4 years, but at the end of 3 years, they come to check because you call them to say, I think something is not quite right on the calibration, might as well come earlier. That's when the remaining carry amount of the previous one will be written off. But if they change the parts inside, all right, or they change the motor, of course, you don't write off the motor. The motor has got its own depreciation rate, isn't it? So that carries on as this. So this occurs regardless whether the cost of the previous inspection was identified in the transaction in which the item was acquired or constructed, such as when a plant is purchased inclusive of this. Now, this is a practical problem. You buy a machine from Germany at a certain price, so many marks or so many euros or whatever it is. It includes 3 servicing free. Now, it includes servicing, not free. It includes the 3 servicing. Now, the servicing is already in the part, in the machine. Let's say we make it simple Malaysian ringgit. Let's say you bought the part from the machine from Germany, 1 million ringgit with 3 servicing. Now, when the engineers come over, service the first part, how much of that are we going to charge to the P&L account? Then people have asked the question, I don't know, man. I bought this machine with the service. They never tell me how much. Now you got a mismatch between the standard and the real life. Not because the standard is wrong or the real life is correct, but because there is a mismatch. So what you need to do now is, and what is being done in practice is, when the machine comes, you get the manufacturer to indicate how much is the service portion. All right, to indicate how much is the service portion as a statement. So you know very well, out of the 1 million, let's say 300,000 is the service portion for all the technical mumbo jumbo flying over from Germany and whatnot and whatnot. Let's say that I just round up to 300. So every time they come and do, 100,000 will be written off to P&L account. All right, I mean, for 3 years, when a new machine comes, the first 100,000 over 3 years, you write it off. Then when they come and inspect the second time, the next 100,000 over 3 years, you write off, which is already embedded in the cost of the 1 million and the third one, and so on. So this is what it states here, you see. This occurs regardless of whether the cost of the previous inspection will identify the transaction in which it was acquired or constructed when a plant is purchased inclusive of service costs. So another way of identifying is, if the manufacturer doesn't tell you, you go to a third-party vendor of a similar item and you say, if you are able to service my machine, how much would you charge per service? So you can use that as an indicative item, indicative of the service. So identification of service costs may be determined from the supplier, or if this item is not possible, comparing the stand-alone price of the plant and the stand-alone price of servicing from maybe a competitive supplier or from the same supplier. You ask him, if I was to buy a servicing package, how much would it cost? You can use that, all right? So these are techniques to identify, because you need to identify that and write it off from the plant. Alternatively, if you cannot get both, So when people come and do an service, the estimated cost of a future inspection may be used as an indication of what the cost of the existing inspection component was when the plant was acquired or installed. All right. So you can use the existing cost to give an indication of what would have been the amount that should have been charged of. This is all estimation. So without that estimation, it's difficult to comply with the standard. So that's why estimation uncertainty form a significant part of the management's duties. And you must make the estimation as close as possible to the reality, right? And the accountant is going to pay a lot of attention to that. Measurement and recognition. All right, elements of cost under these paragraphs 15 to 28. So when the standard talks about the property PPE that qualifies for recognition is always measured at cost, right? Always measured at cost, which is on paragraph 15. Subsequently, only you can talk about. This is initial recognition. At recognition, always at cost. That's why when I say you buy something from somebody, the other party values that item, but when you buy it, that value is your cost. So it's always at cost. So you cannot say, hey, no, man, I bought it at valuation. We both valued it. And then that's a valuation. It's not quite the way we look at it now. The seller is the exit price under MFRS 13. The exit price is the fair value. All right, the acquirer is acquiring it, that's his cost. So the cost of PPE comprise the purchase price, obviously, import duties, non-refundable purchase taxes, and deducting trade discount and rebate. That, of course, that's quite simple. The second part is any cost directly attributable to bringing the asset to the location condition for it to be operating as intended. Also very simple. This is all primary stuff, I would say. Then the third one is what I mentioned just now. The initial estimate of the cost of dismantling and removing the item and restoring the site, right? Dismantling, removing, and restoring. DRR for short, okay? On which is located, or the obligation for which an entity incurs either whether the item is acquired or having used the item during a particular period for a purpose other than to produce inventory. Don't confuse this with the first part. This is an or. Using it for a particular period other than to produce inventory also include. This is an or portion. The one before the or is the normal one. Okay. So applying the MFRS 102 or IAS 2, cost of obligation for dismantling, removing, and restoring the site on which the item is located that are incurred during a particular period because they're having used the item to produce inventories during that period. All right, so therefore, if you're talking about inventories, it is also coming under IAS 102. If you're talking about PPE, it's coming under 116. So the obligations for costs accounted in accordance with 102 or 116, both same, are recognized and measured in accordance with 137 provision. That means when you create a provision for a future DRR, that means the future you're going to dismantle, remove, and restore 20 years down the line, and you discount it. What is it? A provision. A provision, you must follow MFRS 137. So in this case, we are going to debit that discounted value to the PPE first and credit to provision in the balance sheet. All right? Debit to the PPE and credit to provision. Why debit to the PPE? Right? So you can see here on the slide 41. Sorry, the mouse is so sensitive, I just touched it. Initial estimate of the cost of dismantling. The cost of the PPE. This is an recognition, initial recognition, the initial estimate also tambah to the cost of the dismantling and removing the item and restoring. All right. And that's why you have to calculate that figure and put it as debit to the asset and credit into the provision contingents in the P&L account. Sorry, in the balance sheet or statement of financial position as a provision. Okay. And after that, you have discounted it, right? Then you got to unwind that discount or unwind that difference. And the difference will go to the P&L as interest. I'm going to show you the workings in a short while, if you're not clear, but let me come to it first. Let's finish some of these. So elements of cost, remember we are talking about the elements of cost. These are the directly attributable costs, directly. Cost of employee benefits. Employee benefits is defined in MFRS 9. Long-term benefits, short-term benefits, retirement benefits, post-employment benefits, disability benefits. All these can be provided by the company based on the letter of employment of the staff. So if you tell a staff that, all right, if you work for this company for 30 years, you will get a lump sum of 500,000. Let's just say that. So that 500,000 doesn't come out of the blue, right? You need to make sure that you are going to create a provision for that, all right? And you must fund that provision. Funding and unfunding makes a whole difference, all right? One, creating a provision is just debiting the profit or loss and crediting a provision. At the end of the period of 30 years, you got a huge provision, but you got no money to pay. So you must equivalently take out an equivalent amount of funds and put it in a bank account or a separate fund. And that's invested or whatever is done with it. So that when the time comes, that cash is available. That's called funded. Okay. But anyway, these are elements of cost, the benefits, all right, directly from the construction or acquisition of PPE. So some of them you might want to put it in, but this is very rare we put in. Cost of site preparation, yes. Initial delivery on handling cost, yes. Installation assembly cost goes without saying. Cost of testing, whether the asset is functioning properly in assessing whether the technical and physical performance is such that it's capable of being used in the production. So this is what we did just now. We were looking at the extrusion of the pipe, and there was a test run. Professional fees, yes, you will also be capitalizing as directly attributable costs. So engineers' fees, things like that. What are not costs of an item or PPE? Not. Opening a new facility. Oh, we are opening our new factory premises, and here's the machine, blah, 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 and you have a big ceremony and everybody comes and cuts ribbons and whatnot. All right. And food goes. All these costs are nothing to do with the cost of the PPE. Cost of introducing a new product, advertising and promotional, they are all aftermarket. They are nothing to do with the machine. Cost of conducting business in a new location with a new class of customer, including staff training. That's nothing to do with the machine. All that expense. Administration and other general overheads are not part of the machine. Okay, so all that cannot go in. A recognition of cost ceases when the item is in a location and condition capable of operating. If you are adding costs to it that are permitted, that will cease once the business starts to run. Okay, so costs incurred in using the machine or redeploying the machine are not included in the carrying amount. All these are operating expenses, using expenses like you need grease for this, you need, all that oils and the lubrication and the whatnots and the whatnots. All these are nothing to do with the machine. They are all operating expenses. All right, so the example, the following costs should not be included in PPE. Costs incurred before the asset is used or operated at less than full capacity. If you incur additional costs because it's not being operated, don't charge it into the machine. Initial operating losses incurred while the demand for the output builds up. So he said, hey, I haven't come to peak capacity, so my sales are making loss. Transfer the loss to the cost of the machine. These are all part of some of the international frauds that you see in some big companies. They have done this sort of thing. I mean, these are small things. They have done bigger frauds. Initial operating loss incurred while the demand for the output builds up cannot be charged off, as I just said. And cost of relocating or reorganizing part of the entity's operation. Dismantle the whole machine and take to a new factory we just opened somewhere else. That cost, can we add to the factory? Answer is no. Right? Samples produced while bringing the PP to location and condition for it to be capable, recognize the proceeds, right, from selling such item and the cost in the profit and loss in accordance with MFRS 15 or MFRS 140 agriculture. Some of you might be wondering, why is agriculture coming into PPE? Because one of the items of agriculture is a PPE. All right, so I'll come to that shortly. Recognize cost of such items using measurement methods in MFRS 102. This is inventory, which is lower of cost and net realizable value. So when you talk about the cost of whatever produced the proceeds, that cost is on inventory.